Your bank sent you a letter last week. It said they value your relationship. It said they are here to help you build a better financial future. Every word of that letter was carefully written by a team of lawyers and marketers, and almost none of it was true. Let's run the real math on what your bank actually does with your money and what it costs you every single year. Let's be clear about something before we start. Banks are not charities. Banks are not your financial partners. Banks are businesses. And like every business, they exist to generate profit. The difference between banks and most other businesses is that banks generate their profit directly from the gap between what they pay you and what they charge you. That gap is their entire business model. And they have spent decades designing every product, every fee, every policy, and every customer interaction to maximize that gap at your expense. Here's the first lie. Your savings account is earning a competitive rate. The average savings account interest rate at the largest banks in America is approximately 0.01% to 0.5% annually. On a $10,000 balance, that is $1 to $50 per year. Meanwhile, those same banks are lending your money out at 7% mortgage rates, 22% credit card rates, and 10% personal loan rates. Your bank takes your $10,000, lends it to someone else at 22%, collects $2,200 in interest, and pays you $1 to $50 for the privilege of using your money. That is not a competitive rate. That is an extraction mechanism dressed up as a savings account. The fix is simple and available to everyone. High-yield savings accounts at online banks currently pay between 4% and 5% annually. On that same $10,000 balance, that is $400 to $500 per year instead of $1 to $50. The difference over 10 years is approximately $4,000 to $5,000 in pure interest income. Money you earn by doing absolutely nothing except moving your savings to a different institution. Your bank knows you could do this. They count on the fact that most people will not. Here's the second lie. Your checking account has no monthly fee. Almost every major bank charges a monthly maintenance fee on checking accounts ranging from $8 to $25 per month. The fee is technically waivable if you meet certain conditions. You need to maintain a minimum balance of $1,500 or $2,000, or receive a direct deposit above a certain threshold, or make a certain number of debit card transactions. These conditions are not designed to be easy. They are designed to be just achievable enough that you believe the fee is avoidable, while being just difficult enough that millions of customers pay it every month without realizing it. The average American pays approximately $150 to $300 per year in bank fees they did not know they were paying. Over a lifetime, that is $6,000 to $12,000 handed to a bank for the privilege of storing your own money. Here is the third lie. Overdraft protection is a service that helps you. Overdraft protection is one of the most profitable products in banking history. Here is how it works. You spend $5 more than you have in your account. Your bank covers the $5. Your bank then charges you $25 to $35 in overdraft fees. You paid $25 to $35 to borrow $5 for approximately 24 hours. That is an annualized interest rate of approximately 18% to 26%. You read that correctly, 18,000%. The most predatory payday lender in America charges less than your bank charges for overdraft protection, and your bank markets this as a feature, a service that protects you, a benefit of your account. The average household pays approximately $250 to $350 per year in overdraft fees. Over 10 years, that is $2,500 to $3,500. From a service designed to help you. Here's the fourth lie. We offer the lowest mortgage rates for our loyal customers. This is one of the most persistent myths in personal finance. The belief that your existing bank will give you a better mortgage rate because of your long relationship with them. Research consistently shows that borrowers who accept the first mortgage offer from their existing bank pay between 0.25% and 0.5% more in interest rate than borrowers who shop multiple lenders. On a $300,000 mortgage over 30 years, the difference between a 7% rate and a 7.25% rate is approximately $16,000 to $18,000 in total interest paid. Your bank is not rewarding your loyalty. Your bank is counting on your loyalty to prevent you from shopping around. Loyalty is the mechanism through which they charge you more. Here is the fifth lie. Credit card rewards are free money. Your bank offers you a credit card with 2% cash back on everything. You think you are getting free money. You are not. The merchant pays a processing fee of 1.5% to 3.5% every time you swipe your credit card. That processing fee is built into the price of everything you buy. When you pay cash, you pay the same price as the credit card user, but without the processing fee cost being borne by the merchant. Some merchants pass this cost to cash customers through credit card surcharges. Most do not. The result is that cash customers subsidize credit card rewards programs. You are not earning free money from the bank. You are being given back a portion of the money that was already extracted from the merchants you shop at. And for the roughly 40% of credit card users who carry a balance, the rewards are completely wiped out by the interest charges. You earn 2% cash back. You pay 22% interest. That is not a rewards program. That is the most expensive cashback program in financial history. Here is the sixth lie. Your money is being kept safe. When you deposit money in a bank, you do not own that money in the traditional sense. Your deposit is a loan to the bank. The bank is legally allowed to lend out up to 90% of your deposit to other customers. Your $10,000 sitting in a checking account has approximately $1,000 of actual cash backing it at any given time. The remaining $9,000 is out as someone else's mortgage, car loan, or credit card balance. This is called fractional reserve banking, and it is legal, standard, and known to regulators. But your bank's marketing never mentions it, because telling customers their savings account balance represents a claim on money that mostly does not exist in physical form is not great for customer confidence. Now, here is where this gets uncomfortable. FDIC insurance protects deposits up to $250,000 per depositor per bank. So in practice, most Americans are protected from individual bank failures. The lie is not that your money is at risk. The lie is that your money is sitting in a vault waiting for you. It is not. It is working for the bank right now, earning returns for the bank, and you are getting paid $1 to $50 a year for the privilege of providing that capital. Here is the seventh lie. Financial advice from your bank is in your best interest. When a bank employee recommends a product to you, a CD, a savings account, a mortgage, an investment product, that recommendation is filtered through the bank's profit incentive. Bank employees are often compensated based on the products they sell. A recommendation to open a high-yield savings account at a competitor does not earn a bank employee anything. A recommendation to open the bank's own savings product earns them a commission or helps them hit a sales target. The financial advice you receive at a bank branch is sales advice dressed up as financial guidance. It is not illegal. It is not even unusual. But calling it unbiased financial advice is the most comfortable lie in banking. So what do you actually do with all of this? The answer is not to put your money under a mattress. Banks serve important functions: FDIC protection, payment processing, credit access. These are real and valuable. The answer is to stop being a passive customer and start being an informed one. Move your savings to a high-yield savings account. The interest difference over a decade is thousands of dollars for doing nothing except choosing a different institution. Eliminate bank fees. Credit unions and online banks typically charge 0 monthly fees and 0 minimum balance requirements. Switching takes 30 minutes and saves you hundreds of dollars per year. Turn off overdraft protection. Opt out entirely. A declined transaction is embarrassing. A $35 fee for a $5 overdraft is expensive. Choose the embarrassment. Shop your mortgage. Get quotes from at least 3 lenders before accepting any mortgage offer. The difference between the best and worst rate you are offered could be $15,000 to $20,000 over the life of your loan. Pay your credit card in full every month. The rewards are only free money if you never pay interest. The moment you carry a balance, the rewards program is working against you, not for you. Ryan and his wife have banked at the same institution for 11 years. They have a checking account, a savings account, a mortgage, and 2 credit cards, all at the same bank. They think of themselves as good customers. The bank thinks of them as a reliable revenue source. Ryan's savings account earns 0.01%. He pays $180 per year in account fees he mostly does not notice. He has paid $2,100 in overdraft fees over 11 years. His mortgage rate is 0.3% higher than the best available rate because he accepted the first offer. His credit card rewards earn him $340 per year in cash back. His credit card interest charges cost him $520 per year because he occasionally carries a balance. Ryan's bank relationship cost him approximately $1,500 to $2,000 per year in unnecessary fees, lost interest, and premium pricing. Over 30 years, that is $45,000 to $60,000 from one banking relationship. With an institution that sends him letters every quarter telling him how much they value his business, the bank does value Ryan's business. That is not a lie. The lie is in what value means. Value to the bank means Ryan is a reliable source of the $1,500 to $2,000 per year they extract from him without him noticing. So the next time your bank sends you a letter telling you they are here to help you build a better financial future, ask yourself one question. How much money did I pay this institution last year in fees, lost interest, and premium pricing that I did not have to pay? Because that number is the most honest statement your bank will ever make about your relationship, and they will never put it in a letter.